You want those key insights, those real aha moments, but without feeling like you're drowning in information. We totally get that.
Yeah, finding the smart cuts.
Exactly. And today, we're diving into a really foundational text for anyone interested in investing, Security Analysis by Benjamin Graham and David Dodd.
Oh yeah, the absolute bedrock,
Well,
often called the Bible of value investing. And it's amazing how relevant it still is, even though it first came out, way back in 1934.
incredible. We're actually using insights from the sixth edition, which marked its 75th anniversary.
Think about that timing, though, 1934.
Right. It came right out of the wreckage of the 1929 stock market crash and the Great Depression.
So Graham and Dodd were looking at this financial landscape that was just, well, chaos. They
Yeah.
were trying to bring some logic, some order to what they called the uncharted financial wilderness.
And that's kind of our mission for this deep dive, isn't it? To pull out that timeless wisdom.
Exactly. Distill those core principles and see how they still apply, how they can guide you in today's markets, which are definitely different, but still have their share of craziness.
Okay, so let's get right into the heart of it. Value investing. What's the core idea there?
Well, at its simplest, it's about buying securities, stocks, bonds for less than their fundamental or intrinsic worth.
The classic buying a dollar for 50 cents.
That's the analogy, yeah. And tied right into that, maybe the most crucial concept, is the margin of safety.
Margin of safety, explain that a bit.
It's basically building in a cushion.
Yeah.
You buy something for significantly less than your estimate of its true value. That way, if your analysis is a bit off, or things don't go exactly as planned, or you just hit some bad luck.
You've got room for error.
Precisely. It protects you from losing your shirt. It helps you avoid feeling overwhelmed by risk because you've built in that buffer.
Makes sense. They were really pushing against the emotional side of investing, right? What they called the sirens of market speculation.
Oh, absolutely. They saw speculation based on emotion or market fads as incredibly dangerous. For them, buying a stock wasn't just buying a ticker symbol.
It was buying a piece of a business.
Exactly,
Oh.
becoming a part owner. And they urged you to analyze that small slice with the same kind of rigor you'd use if you were thinking about buying the entire company.
That really grounds your analysis, doesn't it? It's not just about where the price might go tomorrow.
It gives you an anchor. You're focused on the business's actual value, not just market sentiment.
Okay, and this leads to another one of Graham's famous distinctions. The market as a voting machine versus a weighing machine. I love that one.
Yeah, it's brilliant. The idea is, in the short run, the market acts like a popularity contest, a voting machine. Prices jump around based on sentiment, news, hype.
Who's popular today?
Right. But Graham argued that over the long term, the market behaves like a weighing machine. It eventually assesses the actual substance, the true underlying value of a business.
So the value investor focuses on the weighing, not the voting.
That's the goal. Tune out the short-term noise, the popularity contest, and focus on what the business is actually worth based on its long-term prospects and performance.
And this ties into their investment approach, right? They weren't trying to guess market direction.
No, definitely not. They advocated for a bottom-up approach. You sift through individual companies, looking for those bargains, those mismatches between price and value, regardless of whether the overall market is going up, down, or sideways.
So forget market timing.
Forget market timing. It's a fool's errand, basically. The focus is on finding specific, undervalued securities.
And what about holding cash? When does that make sense in their view?
Well, they saw cash as sort of the default position. You only commit capital when you find a genuine bargain that meets your criteria, including that margin of safety.
So if you can't find anything compelling,
You wait. Holding cash is perfectly acceptable, even preferable, to overpaying or speculating.
okay, the million-dollar question then. How do you figure out that intrinsic value? What's a company really worth?
Ah, yes, the central challenge. And interestingly, Graham and Dodd, they deliberately didn't give a single rigid formula for it
Really? Why not?
because they knew it wasn't a precise science. It involves judgment, estimation, particularly when you start trying to forecast future earnings.
Yeah, predicting the future is always tricky, especially for some types of businesses.
Exactly. They specifically mentioned businesses they saw as inherently unstable. And you can see how that might apply to, say, a lot of fast-changing tech companies today.
So how did they suggest approaching earnings forecasts?
They had two key rules, really. First, give preference to companies with a history of stable, consistent earnings. That track record gives you more confidence.
Makes sense. And second?
Second, if you are looking at a company with more volatile earnings, you need to be much more conservative in your projections and look much further back into its history. Be more demanding.
So it's not just about the numbers on the page. There's a qualitative aspect, too.
Hugely important. Typical analysis, especially back then, often leaned heavily on the quantitative action, the balance sheets, the income statements. But Graham and Dodd stressed that you have to look at the qualitative side, too.
Like what?
Like the nature of the business itself. Is it durable? Does it have competitive advantages? And critically, the character and competence of the management team.
They also warned about getting swayed by temporary conditions, right? Like if an entire industry is suddenly booming or slumping.
Yes, precisely. They pointed out that abnormally good times or abnormally bad times for an industry usually don't last forever. Competition enters or conditions change. You need to look beyond the immediate situation.
And judging management. That sounds subjective. How do they recommend tackling that?
They admitted it wasn't easy. Reputation matters, sure. But the most convincing proof, they argued, is a solid long-term track record of consistently increasing profits and shareholder value.
Actions speak louder than words.
Pretty much. But they also cautioned against just looking backward. Even if the numbers look good, you need to consider any reasons for future doubt or distrust regarding management's integrity or capabilities. Stability in the business and its leadership was a huge qualitative factor for them.
Thinking back to the 1930s, where did investors even get the information to do this kind of deep dive? No internet, no instant data feeds.
Right, it was detective work. They relied on things like the reports companies sent to shareholders, though the quality and completeness varied a lot.
Okay.
Then there were regulatory filings, especially for railroads and utilities, which often had detailed info. Trade publications were key specific journals for specific industries, like oil, autos, railways.
Or like reading the industry gossip almost?
Well, maybe more than gossip, actual data sometimes. And even the applications companies filed to get listed on exchanges contained useful background. This was pre-SEC in its modern form. They did note a push towards more disclosure, even for over-the-counter stocks. But yeah, you had to dig.
So you do all that digging. How do you know if you're making an investment or just speculating? That distinction seems fundamental for them.
Absolutely critical. Their definition was quite clear. An investment operation is one that, after thorough analysis, promises safety of your principal and an adequate or satisfactory return.
Safety of principal and satisfactory return. Both.
Both. If an operation doesn't meet those requirements, based on your analysis, it's speculation. Period.
And importantly, it wasn't about the type of security, was it? It was about the price.
Exactly. A blue-chip stock isn't automatically an investment. If its price is too high, buying it becomes speculation because that safety of principal aspect is compromised. There's no margin of safety.
So a great company bought at a crazy price is speculation.
In their view, yes. They explicitly stated that, contrary to common Wall Street thinking at the time, many common stocks of strong companies were often speculative purely because they were overpriced.
Let's switch to bonds, or fixed value investments as they called them. What was the main focus there?
Safety. Above all else, safety. Their approach wasn't about reaching for the highest possible yield. It was about setting minimum standards of quality and strength that a bond had to meet before you'd even consider it.
What kinds of standards?
Things like the company's overall size and standing in its industry. Bigger, dominant companies usually offered more protection. A huge one was interest coverage. How many times over can the company's earnings pay its annual interest charges?
Like a safety ratio for paying its debt.
Exactly. A high ratio means more cushion. They also looked hard at the capital structure, how much debt the company had relative to equity. Even a big company could be weak if it was overloaded with debt.
And they weren't just focused on, say, the value of property pledged as collateral.
No, they warned against relying solely on mortgage lags. The company's overall earning power and financial health were far more important. Their point was, if a company's junior bonds look shaky, you probably shouldn't trust its senior bonds either, regardless of collateral. The whole enterprise needed to be strong.
Were there any exceptions or specific types they looked at?
Well, they did mention things like equipment trust certificates for railroads, which had sort of a double backing the railroad's credit, plus the value of the rolling stock itself. But they were quite clear that bonds for things like new hotels or unproven ventures were generally not suitable for straightforward investment. They even gave specific earnings coverage ratio guidelines for utilities, railroads, and industrials.
What about preferred stocks? Kind of in the middle between bonds and common stocks.
Yeah, they saw preferreds as hybrid securities. They have features of bonds, like a fixed dividend priority, and a claim on assets if the company dissolves. But they also have equity-like features. They noted it could be hard to draw a clear line between a really safe preferred stock and a riskier common stock sometimes.
And income bonds, those sound tricky.
They are. Interest is only paid if the company earns enough. So their quality depended less on the legal one-print and more on why they were created, often during reorganizations of struggling companies. Risky territory, usually.
And guarantees. Does a guarantee from another company make a bond safe?
Only if the guarantor is rock solid financially. A long-term guarantee from a strong company could add real value, sure. But a guarantee is only as good as guarantor backing it up. Short-term guarantees. Less useful.
They also touched on reorganizations, which must have been common back then.
Very common. They noted the shift in bankruptcy law towards court-approved plans aiming for fairness, moving away from older, messier foreclosure processes, and more scrutiny on the committees representing different groups of security holders.
What about the fine print in bond agreements, protective provisions, sinking funds? Did they see value there?
Definitely. Things like rules restricting dividends. If working capital drops too low, those protect bondholders. Sinking funds, where the company regularly sets aside money to repay the debt over time, were seen as desirable.
Like paying down the mortgage.
Pretty much.
Right.
Reduces risk over time. Maybe not absolutely essential for super stable, permanent-type businesses, but generally a good sign. Serial maturities, where parts of the bond issue mature at different dates, achieve a similar goal.
This sounds like a lot of work, not just initially, but ongoing. Is there such a thing as a buy-and-forget investment in their world?
Absolutely not. They were very clear. There are no permanent investments. Things change. Industries, companies, economies. You have to periodically review your holdings. Vigilance is key.
And stay disciplined, right? Avoid getting sucked into market manias.
That was a huge warning, especially during bull markets. The temptation to abandon analysis and just chase momentum is strong. They saw how destructive that could be. Think dot-com boom or others since.
Did they cover distressed investing much? Buying debt of troubled companies?
They mentioned it, but treated it as a specialized high-risk area needing extreme caution and expertise. Not for the average conservative investor following their main principles.
What about things like convertibles or warrants? Securities with options attached?
Yeah, they discussed convertible bonds, bonds you can swap for stock and stock warrants, which give you the right to buy stock later. They acknowledged the speculative appeal and the potential leverage.
But with warnings.
Always. Understand the terms inside out. Understand the risks, like the company calling the bonds back early, which could cap your upside. Know what you're buying.
Okay, let's loop back to common stocks. They talked about a big shift in how people valued them over time.
Yes, a major shift. Historically, value was often tied closely to a company's tangible assets, its book value. But a new theory emerged, especially in the run-up to the '29 crash, that focused almost entirely on future earnings potential.
And Graham and Dodd weren't entirely sold on that new theory, were they?
Not at all. They thought it went too far. While future earnings are obviously crucial, they argue that just projecting past growth forever was dangerous, and that things like the company's actual asset base and its dividend payments still mattered. They shouldn't be ignored.
What about companies reinvesting their profits, plowing back earnings instead of paying dividends?
They saw it as a double-edged sword. Reinvesting can fuel growth, which is great, but only if management invests that money wisely and earns a good return on it. If they don't.
Then shareholders might have been better off getting the dividend.
Exactly. They also noted that the market often seemed to value dividend-paying stocks more highly, the dividend factor. And underlying all of this, again, was the quality and integrity of management. That was non-negotiable for a sound, common stock investment.
When looking at reported earnings, they warned about taking the numbers at face value.
Definitely. You have to scrutinize the income statement. Look for non-recurring items, one-off profits from selling assets, or unusual losses that distort the picture of ongoing earning power.
What else needs careful attention in the income statement?
Proper accounting for inventory, how they handle big, extraordinary losses, and especially depreciation and depletion charges. Companies had, and still have, different ways of accounting for these, which can significantly impact reported profits.
And analyzing holding companies with lots of subsidiaries? That sounds like a maze.
It can be. Getting a clear view of the whole group's performance requires digging into consolidated statements if possible, and understanding how money moves between the parent and the subs.
So don't just look at this year's earnings number.
No way. Earnings fluctuate. They stressed looking at averages over several years, maybe 5, 7, even 10 years, to get a better sense of normalized earning power. And always ask, is this level of earnings sustainable? What could change?
What about valuation metrics, like the price-to-earnings ratio?
They discussed PE ratios, yes, but cautioned against using them rigidly. They noted how the standard PE had changed over time. People used to think 10 times earnings was normal. They suggested that paying much more than, say, 20 times average earnings was generally pushing into speculation.
How does the mix of debt and equity, the capital structure, affect the analysis?
It significantly affects risk and potential return for both bondholders and stockholders. Lots of debt, for example, increases risk for equity holders, but might leverage returns if things go well. They also pointed out how holding company structures could be used to manipulate the apparent capital structure of the operating businesses below.
Another technique they mentioned was comparative analysis, comparing a company to its peers.
Right. Looking at a company's financial ratios, profit margins, growth rates, and comparing them to similar companies in the same industry. It helps you spot outliers, who's doing better, who's lagging, and why.
But with caveats.
Of course, comparisons are only really valid if the companies are truly comparable, similar business models, similar size, etc. And even then, it just provides context. It doesn't eliminate the fundamental uncertainty about the future.
Okay, so after all this work, where did they suggest investors actually find these undervalued gems?
Well, they noted that the big, well-known stocks might only be truly cheap during major market downturns, but opportunities in what they called secondary issues, smaller, less followed companies, might pop up more often.
Because fewer people are looking.
Exactly. Market neglect. They also believe that undervalued bonds and preferred stocks of decent quality could often be found just through diligent searching, simply because they were overlooked. Sometimes valuation discrepancies arise from complex situations like intercompany holdings or guarantees, or even clear mathematical anomalies in how related securities are priced.
They even gave a nod to global investing, which is obviously huge now.
Just a brief mention, acknowledging its growing importance, but also the added complexities, currency risk, different accounting rules, maybe less transparency. It adds another layer of analysis.
So let's try and wrap this up. If you had to boil down the absolute core, timeless principles from Graham and Dodd, what would they be?
Okay. First, thorough analysis is non-negotiable. Do your homework.
Right.
Second, always, always demand a margin of safety. Protect your downside.
Crucial.
Third, think like a business owner, not a speculator. View securities as pieces of actual businesses.
Got it.
And fourth, know the difference between investment-seeking safety and adequate return and speculation, which is everything else, and stick to investing.
And you really believe those ideas, born in the 30s, hold up today?
I absolutely do. Markets change, technology changes, information flows faster, but the fundamentals of business value and, maybe more importantly, human psychology, fear, and greed haven't really changed that much. Irrationality happens.
So discipline wins out.
A disciplined, value-based approach provides a solid framework and anchor regardless of the market weather.
Okay, a fantastic deep dive. So here's something for you, our listener, to think about. How can consistently applying these core ideas, that relentless focus on value versus price, that insistence on a margin of safety, provide you with a kind of compass to navigate today's often volatile and confusing markets? Something to consider in your own investment thinking.